Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Pascal Wagner. He's a former venture capitalist turned passive investor who built a $250,000 a year portfolio through 30 plus investments. Starting as a VC at Techstars, he deployed $150 million into over 300 companies, and he learned how top financial institutions analyze deals, manage risk, and make smart investment decisions. Now he uses those skills to teach others how to build wealth. Today, he's educating over 200,000 investors monthly as a host of the best ever CRE podcast network. And he's sharing strategies to create six-figure passive income portfolios through real estate and alternative investments. Pascal, thanks so much for coming on the show today, man.
Thanks for having me on the show, Kent.
I'm very excited to talk with you because, it's not often that we get people that are really, for lack of a better word, kind of professional passive investors, right? Professional LPs, if you will. And I know you've got some houses and things you do on the side, but a lot of your portfolio is as a limited partner. And you've got that VC background where you're evaluating deals. You're obviously very sophisticated at it. And now you're coaching people. So you've actually got a framework on how to tell others how to do it. And so tons to unpack there, but I think a lot of lessons for our listeners on how to just be a really, really high caliber limited partner. I'm sure we'll get some great nuggets on what to ask, what to look into. So excited to dig into that. But before we do, Pascal, tell us a little bit more about who you are and how you got to be where you are today.
Yeah, happy to. So my story starts, as probably most people, where when I was very young, when I was 23, I read a book called Rich Dad Poor Dad, which got me interested in real estate. And I bought my first house at 24 with my best friend, where we bought a single family home and we rented it by the room to increase the cash flow. So a lot of people call that house hacking or co-living. And I did that over a decade ago now. And, I've always kind of had real estate on the side. I launched a company that did virtual reality in real estate. And after realizing, we raised a bunch of venture capital money, I realized that even though we were generating $1 million a year, it wasn't going to be a big billion-dollar company, which when you raise venture capital, those are the expectations. So I ended up selling that company to the largest national photography firm in the United States. And I was trying to figure out what I wanted to do with my time next. And I ended up working for one of the venture capital firms that invested in our company. And that company was Techstars. And, happy to dive in later, but basically at Techstars, through my, career there, I basically got to be the person on the front lines that got to pick which companies that we would invest into. So the chief investment officer of, there's 300 employees at this firm. They kind of set the strategy for this $150 million fund that they had just raised. And they needed someone to help find all of the opportunities that match the thesis and then apply the framework that they had already kind of put together and do that for all of the startups. And so that's where I really learned how institutions put together a strategy and a thesis, go raise tons of money, in this case, $150 million, and then using filters and a due diligence process to figure out which of those companies we would invest into. So like every Monday, I would show up to a meeting and I would have to present to the chief investment officer, like, here are the deals that we should invest into and why, and here are the ones that we shouldn't. And so I really got like a firsthand understanding of how institutions approach investing. And while I was there in 2001, my dad had passed away from old age, and he was over 80. And all of a sudden, although he was old, it wasn't expected. And all of a sudden, my mom was left with a couple $1,000,000 and no real plan. And my dad was the person in our family who took care of all the finances. And so my mom really didn't know what to do. And so I needed to step up and help her. And so one of the first things I did when you come into that kind of money and you're trying to figure out, like I had to figure out how to help my mom basically live through the rest of her retirement off the money that he had left her. And so reached out to several different financial advisors and asked them, hey, how can I position this to generate the cash flow and grow? And after talking to 3 different ones, you start to realize that financial advisors are incentivized to keep you in the market. And, if you go invest in real estate or basically the vehicles that can generate you cash flow, they don't get any benefit from that. And so I realized then that wasn't the path to go down. And so I kind of like turned around. I was like, okay, who can I learn from to figure this out? Initially, after that, I took a bunch of that money and invested it into the strategy that I knew would generate cash flow. So this co-living. And so I've built up a portfolio of 11 homes in Atlanta, and that's where half of our family's income come from. And there was a point where pretty much all of our cash flow when I first started was coming from that. And I realized that, okay, I have a ton of risk and my mom's future tied up into this one strategy in, this one asset class of single family homes in Atlanta, Georgia. And you have one hurricane come through or one legislation change and there's a lot of risk there. And so I realized at that point that I had to figure out how to diversify that portfolio. And so I went to a bunch of different conferences. I'm in a couple different mastermind groups, and I've found a couple mentors inside GoBundance, which is this mastermind group where there were or are people that are actually living off of their investments, the actual passive income that everyone talks about. And so those were the people I globbed onto, right? Like, tell me, where are you investing? What deals are you investing in? Why are you investing here? How much money do you have? How much does it actually, try and learning from mentors, right? And I realized that, me working at a venture capital firm where institutions gave us money to deploy the capital, the same thing happens in real estate, right? So I took a good chunk of money out of that co-living portfolio that I had, and then started to allocate that into different deals as an LP. And my goal was to diversify the income streams from my own portfolio. And I knew that I couldn't do it all myself. I couldn't invest in a self-storage thing and multifamily apartment building and oil and gas, there's no way. The only way to do that is through leveraging other people's expertise. And having worked at that venture capital firm, I understood, okay, there are professionals like where I was that their entire job all day is to do that thing, deploy that money into that specific asset with a specific strategy. So I was pretty familiar with the concept. And long story short, after 23 investments and investing over $3.3 million across different LP investments, now that portfolio generates me $150,000 a year, and the co-living portfolio generates $150,000 a year. And I just realized throughout that process, no one teaches you how to become an LP or how to strategically invest in these deals or how to do proper due diligence and what does due diligence even look like? And so that's very much led to where I am and what I'm doing today.
I love it, man. That's a fantastic story. And there's a ton to unpack there around, the whole arc of, going VC, having this event happen in your family, having to figure out how to provide for your mom, which I think is obviously, a catalyst that, a lot of us can appreciate and try to figure out. I think, a lot of our parents are in that same generation, right? Where, maybe the dad handled a lot of the finances and you're trying to set them up for success in retirement. I think a lot of my listeners, I think a lot of our investors are trying to set themselves up for retirement, and so I think there's a lot a lot we can unpack. I'm curious how, as you look at it from your lens, and where, okay, you're talking to these financial advisors, and the financial advisors, yes, are obviously incentivized to keep you in the market because that's how they make their money, right? And there's a little bit of a conflict of interest there, right? Because this may not be the best investment. It's definitely not the best to be all in one basket, right? And be not diversified, which is how most people are, right? Unless you've kind of done this work. So what was it though at the beginning that when you're talking to these financial advisors and you're like, oh, I don't want to be in stocks? Because I think most people would just listen to a financial advisor and say, yeah, there's stocks and bonds, and that's how you're diversified. So what was it that set you on real estate and said, you know what, I got to be in real estate?
I mean, for me, it was pretty clear. It was like I've already generated a ton of cash flow from real estate, right? I've been doing it for over a decade. That's how I've been able to, start other companies, is because I've had, I remember when I was 25 years old, I had $3,000 a month in income coming in, net income coming in from my properties. And that was enough for me at that age to not have a job and to be able to take on a couple consulting clients for a couple extra $1,000 a month. And, all of a sudden I'm making like, $8,000 to $10,000 a month and piecing income together from different places. So I had the experience of knowing that real estate is a great place to, one, provide cash flow, and two, I almost paid no taxes every year because I'd used depreciation. And so I knew that these tools were already there. And I think growing up, I've always heard of people investing in apartment buildings and self-storage, and you think it's like, oh, you need millions of dollars or you need to be incredibly wealthy to do that. And like you somewhat do, right? Like you need to have at least $1 million. You need to be accredited, but those opportunities are out there. You just need to know where to look.
Sure. And how to evaluate them, right?
And how to evaluate. Yeah, totally.
So that takes me to like my next kind of train of thought here is, so you've got this VC experience, you've got this experience just going through deal after deal after deal, learning due diligence, learning underwriting, learning how to evaluate, right? How has that experience made you a better real estate investor for you and your mom and your own portfolio? What are the key takeaways that our investors can learn from you through that experience?
Yeah, cool. So I will walk you through in short over my 3-step process that I use
Love
to
it.
simplify everything down to.
Love it.
So I'll try and draw parallels to the venture capital world and how a fund manager raises a fund to try and help illustrate the story. So how most funds work is you have a thesis. So at Techstars, the follow-on fund that I was specifically in charge of, the thesis was, hey, Techstars is an accelerator where companies come in for 10 companies come in for 3 months, and they get a bunch of mentorship and coaching, and then we help them raise money, and then wish them luck. And Techstars needed a way to continue investing in the best companies out of their portfolio. And so that was the thesis. We're going to invest in the top 20% of companies that go through our accelerator program and put an additional check into it. And so with that thesis, they then went out to the market and raised a bunch of money. And so, they're raising from the Firefighters Association, the Teachers Pension Fund, and they raised $150 million. And so now they basically have gone out to a subset of people and told them the strategy that they are going to pursue. And if the firm strayed away from the strategy that they set, they wouldn't be able to raise more money in the future, right? It also probably would be a big SEC violation. But, the idea is that when I'm an investor and I'm thinking about my own portfolio, it's very similar process. I had a goal in mind. So in my case, in my mother's case, My goal was to help her generate an additional $100,000 a year so that she could live off of that in her retirement. And so that was the big overarching thesis. And so then I had to work backwards from that. So the first step is getting clarity on the goal and the plan. And so for us, it's, okay, if you are trying to get $100,000 in passive income, how many investments does that take? Is that 10 investments at $100,000 each, and we expect every investment to generate a 10% return? Is it 20 investments at 50K each, and some of them are at an 8%, and some of them are at 12, and there's going to be a mix, right? Like, you have to have some sort of plan or strategy. And I think that's where a lot of people go wrong, is they first start with a deal, and the deal comes to them and they're trying to evaluate the deal. They're trying to vet the deal. And really, this is like, so when I talk about my job at Techstars, I saw thousands of companies, but we had very strict filters that would cross companies off our list within 5 minutes. And so just as I was looking for cash flow for my mom at the venture fund, we had very specific things like, we don't ever want to be the lead investor. We only want to invest in something else that someone else is leading the round on. We don't want to be the largest check. We will only invest in rounds or companies that are raising at least $700,000 so that they have enough capital to, so there are all these criteria. And same thing when I'm investing, I had the same idea. So, I need to generate at least an 8% return. I'm looking for opportunities that generate cash flow within 3 months of me investing my capital, yada, yada, yada. So step one is getting clarity on what is the plan, macro, and then what is the micro investment thesis or filter that helps me quickly go through deals. The second part is finding and filtering that deal flow. So, most investors, if you're a retail investor, what happens is you might get an email in your inbox from an operator because you signed up on their list, or you might see an ad or two on Facebook, or you might be in the best ever CRE group or something like that, and you might see people talking about a deal. But when the best investors, the institutions, are looking at hundreds, if not thousands of deals before placing an investment, and it makes sense, right? Like, if you're looking at 5 deals a month, like, the likelihood of you investing in the cream of the crop versus if you're looking at 100 deals a month is day and night, right?
Yeah.
And so
totally.
The whole point about step 2 is, how do you get all the deal flow? And so, signing up on, there's all these different things that you can do to do that. And then the third step is where people usually try to start, but it's the third step, right? So vetting the operator. So in our case, like, when I'm an LP investor, I have call it a 100-point checklist. And so the point of the checklist, just like in passive investing or at an institution, is to make it so that you cross every T, dot every I, and you don't miss anything. And every time a deal goes sideways or doesn't turn out as you expected, you typically add steps or questions to your checklist, right? Because it's preventing you from making a mistake you may have made previously. So, went through it very quickly, but yeah, step 1 is getting clarity on where you're trying to go and what's the micro investment. Step 2 is finding the deal flow. And step 3 is then, once you've filtered the 1,000 deals into the top 5 that you think are interesting, what is the set of processes that you go through, whether it's questions, whether it's background checks, whether it's, getting a third party audit or doing an on-site visit. You can pick and choose what you do in that process, but the point is, it's important to have a process that's systematic.
Yeah, I love that. It's really just interesting to me how similar it is, and this is probably your VC background, to just the process we go through to find deals. It's the same thing. It's where my company, we go out and we look at thousands of deals every year, and our metric is like, we're looking at 130 to 150 deals to find one that's a good one, right? And then so you just think about, I was thinking about as you were saying this, like having clarity on the goal, right? You've got to have clarity on your goal. Same thing. We have to have a very clear thesis because, if you don't know where you're going, how do you know when you got there? Right. And so it's just so similar and striking, but it makes a ton of sense because what is your goal? Is it to retire? Is it to go on a big vacation? Is it to put your kids through college? When is it to retire? Right. At what age? Right. How much money do you need? Right. How much money? And really getting down to the root of it. I love how you kind of step through that, working that backward to say, okay, you're going to need this much per month. What does that break down from a deal standpoint? How much are you going to get per deal? Okay, so how many deals do you need? And you get to the point of, okay, well, I need this many deals because I'm going to deploy this much capital. And you can really, really get honed in on what your goal is, right? And what you have to do and say, okay, this year I have to invest maybe in this many deals, right? And the next year, and maybe it's a 5-year plan or whatever it is, but getting clear on that goal and timeline, types of deals that align with your risk. Like that's what I find a lot of investors don't understand their risk tolerance. And I think getting clear on your goals is understanding your risk tolerance. Cause I have a lot of people say to me, oh yeah, I'll take on risk, and this, it's like, and then we start to unpack that. Well, how would you feel? What does risk mean to you? Right. And,
right.
And then you find at the end of the day, they're like, well, I don't know, the kind of, because they're just not clear and they don't understand. And I would say the deals that we do are relatively unrisky in the spectrum of deals that are available. But I think just not having that clarity, right? And then but then I love the idea of, because you also, I find a lot of people get stalled on the 2-yard line, right? And the analysis paralysis or whatever the thing is, right? Where it's just at the end of the day, whether you're an active operator and you're just going to buy your first house, like you got to pull the trigger, or you're a passive investor and you're going to make that bet, you got to pull the trigger. But I think because a lot of people aren't clear on exactly what they want and they don't have a process that they can trust, I think that's why a lot of people get stuck there.
It's exactly why they get stuck. It's because if you don't know what to ask for, or if you're just, you're piecing together from different podcasts, like this checklist or that lead magnet from this operator, and you're trying to put it all together. And it's like, you don't have a system. You're just kind of like, cherry picking from different things.
Well, I'm thinking about it like in our own process, like very similar to what you described in tech. It was, we have a long checklist, right? And it starts with the market and the sub-market and all these dynamics and supply and demand and all these things.
And there are things there that if they don't check the box at the beginning of your process, you don't continue.
That's right. I tell my team, we have to be able to filter out 70% of deals just based on criteria before we get to any underwriting, because it takes way too long to underwrite.
Right.
And so you're exactly right. We try to filter out 70% up front, but I'm just thinking about the clarity that gives us. If we go into an investment meeting and one of my analysts brings that to me and I look at the criteria, like the scorecard, and it checks all these boxes, it takes the emotion out of it, where it's like, okay, these are the things I wanted. I'm getting all those things. So therefore, this is a deal that we should do. It's the same thing for how you're aligning this for investors, right? It's like people get stuck because they get that anxiety, or just people can't move forward without a lack of clarity, right? Is what it is. And it's like that checklist gives you the clarity to where it takes the emotion out, where you're like, okay, I looked at this deal. It checks all my boxes. Therefore, it's a deal I should do. And then you can move forward, I think, with confidence, which I've never thought about the passive investor, like our LP's journey, in the same way before, but you really brought that together for me. So I think that's interesting.
Yeah. Framework that I think has been really helpful for me when I describe it is to think about it as like an experiment, and following the scientific method for the nerds out there. So it's like, my hypothesis is that if I invest in deals that have these things, that I will have an outcome of X return. Mm-hmm. And like you said, it's checking off all those boxes. And then like, that is the bet. That is the experiment you're making. And maybe the experiment won't work out. And then you sit there and you ask yourself, why didn't it work out? Or what could I do differently? And then you add that to your criteria in the experiment, and you keep iterating until you get better. And so the longer if you have a system, you will by default get better over time, which I'm sure you have experience as well of just looking for your own deals.
Oh, for sure. I mean, I will fully admit that my process now is much better than my process when I bought my first house flip back in whatever that was, 2013 or 14 or so. Yes, much evolved over iterations and learning and improving and mentors and all these things, right? And so, well, I love the framework, right? Getting clear on the goals. You've got to look at a lot of deals to find deals that are going to fit your criteria, whether you're an active person like me or you're a passive investor, we've learned. So you got to learn, how do you find deals? How do you filter through all the noise quickly to find what aligns with your goals? And then 3 was really getting down to vetting the operator, vetting the deal, kind of having that checklist. Is that right? Did I capture those?
It's exactly. It's the underwriting. What are all the documents you ask for? What are the questions? Who are the key people? Do they have the right insurance in place? What happens if this goes wrong? It's just asking all the boring questions.
Mm-hmm. Yeah, absolutely. Absolutely. Well, I think such a fantastic framework for investors to follow. I think whether active or passive. And I think the idea that, I could see if I'm playing devil's advocate, right? If I'm like, man, that seems like a lot of work. I got to get this framework, and I got to find all these deals. I got to underwrite all this. So what's your response to that investor who just like knows that they need to diversify? They need to be in real estate because all the richest people in the world are, but they're like, man, I'm already working 60, 80 hours a week and I don't know how to get started. And it's going to be a lot of work to do it like he said.
Yeah. So I will tell you that most people who come through my door are people that have lost money on a deal because they watched a webinar and they were like, oh, I trust this person. And then they wire the money. Right. And then they come back with the tail between their legs and they realize I actually didn't really do any diligence at all. I don't even really know what due diligence, what does that even mean? What does that process look like? I think, you're spending decades of your life to figure out how to generate income. Right. And then you're turning around and spending less than, 5 hours to look at a deal and make sure it's the right fit in a scenario where you could have a complete loss of your capital. Sure. Private equity is significant, it is riskier than public markets in the way that there are a lot of people that can just raise money for a deal and not have any background or,
You can have a lot of bad actors. You can have
a lot of bad actors.
Maybe not even bad, but just don't know what they're doing. And you can just raise capital, right?
Right.
Not the same level of vetting.
Right. It's not like you have to, file with the SEC every single year of everything.
That's right.
So look, I think it feels overwhelming if you don't have a process. But I'm sure, like you've experienced, once you have the filter, it's like deals just come through and the initial filter doesn't really take that much time and effort, right?
No.
And then you've identified the couple where I now have literally, it's like I can watch a webinar and I have this checklist in front of me and I fill it out. And then if I still like the deal, I hop on a call with the operator, fill out the remaining questions, and then I ask for feedback from other people who are in the community or have invested in the, there's a process. There's a spectrum, right? There's family offices that spend years following an operator, who have analysts who will do tons of due diligence, right? And then there's the retail investor who may watch a webinar before investing. And you need to figure out where are you in that spectrum. And everyone will have different things. Some people will do background checks. Some people won't. Some people will do on-site visits to verify that it's a real asset. Some people don't. It's part of, there is all types of things you can do, but once you have that process, it really doesn't take you more than, 5 or 10 hours to decide on a deal. But it is really overwhelming and can take much longer if you don't have a process or a plan or know what you're doing.
Sure. No, I appreciate that answer. And I will tell you, some of our listeners who've been listening for a long time know this. One of my first experiences in real estate was losing all my money in a deal through a crowdfunding site that I did not know what due diligence was at that point, I will admit.
Yeah. I mean,
and so
none of us know what it means.
I can attest to the importance. And that's what made me get really serious. But it was, expensive tuition, as they say.
Yeah, I think everyone has a little bit of that. Yeah.
Well, Pascal, thanks so much for coming on. I really appreciate the knowledge you've left with us. And I think there's a lot of good nuggets coming out of here. Before I let you go, though, I want to take you through our keys to success round. I've got 4 questions I want to ask you. This first one will be right up your alley. You have a list of at least 100. It's if you were a limited partner, right? And you're going to make an investment, but this is a weird scenario where you don't know anything about the deal and you don't know anything about the operator, but you got to send that check. What is the one question that you are going to ask?
So I think the generic vague answer is you're looking at their track record. I think more specifically, I think there are like a nugget I think I would look for is like, let's say you're looking at a multifamily apartment complex or a self-storage operator. Maybe a more advanced hack is like, tell me the net operating income growth that you've had across all of your projects to date. Because I think what's interesting about net operating income growth is that, in the time frame of 2016 to maybe 2021, there are a lot of operators that have gotten the market and didn't need to execute their business plan and benefited from lowering interest rates, which meant people were more and more willing to spend more money to acquire a property. And so a lot of operators had massive returns, but didn't execute on their business plan because they didn't even have to, right? And so I think what I look for, I think an advanced hack is like, an operator might have gotten crushed because they picked the wrong time of the market, but that they can execute because they've been able to increase the net operating income of their properties, which lets you know that they've executed on their business plan. So that's what I'm looking for is give me the track record of the showing that they know how to execute, because that's really what I'm investing in.
Yeah, I like that. I don't think we've actually heard that answer on the show before, but I spent some time at a larger private equity firm before I went out on my own. And that was an analysis that they did that always stuck with me was, how much of our return is driven by operational improvement, right? Really our alpha versus how much return is really from cap rate compression, right? And market dynamics. And it was fascinating to look at and understand. It's always made me think in that way. So I appreciate that answer. Next question is, what are you most proud of in your career?
Wow. I mean, if it's related, I think I'm proud that I was able to kind of reach this goal of helping my mom earn $100K, right? I think there was an incredible amount of pressure, right? So first, of course I managed and deployed, over 150 million over the 3 years I was at Techstars. I was dealing with big numbers, but it is different when it is your own capital or your mother's capital.
100%.
And knowing that if I messed it up, like she could end up on the street, right? And I think that pressure and just kind of like going through that process, I'm really proud of myself for being able to pull that through.
For sure. That absolutely is something to be proud of. And what a cool thing to have accomplished for your mom as well.
Yeah.
That's awesome.
Totally.
What's a book that everybody should read?
Maybe unrelated to this, but Atomic Habits has been a big influence for me, by James Clear. Really just talking through the dynamics of like, how do you improve your life through small habits and identities that change your life?
Yeah, it's a great book. I love that one. And last but not least, what is your number one key to success?
Don't reinvent the wheel. So find someone who's already done what you're trying to do and leverage them. I think that's like, instead of trying to do multifamily myself, like I invest in someone like you, right? If I'm trying to learn how to be a better passive investor, I went and sought out mentors that had done it, who could steer me away from the pitfalls. And, one wrong mistake, you lose 50K. So,
For sure.
pretty valuable to go find a mentor in this space.
Absolutely. I've benefited from many mentors and coaches throughout my career, and it's helped me grow leaps and bounds. So totally agree. Well, Pascal, thanks so much for coming on the show. If folks want to learn more about what you're doing, they want to learn about this framework, how can they reach you?
Yeah. So LinkedIn is my platform of choice. You can find me on LinkedIn, but I have a freebie. People usually have issues with finding deal flow. I talked about you want to be looking at hundreds of deals, and most people, barely have any deals come in their inbox every month. And so I share the deal flow that I put together and come across every single week. There's over 700 deals in this thing, and it's updated every week. And so you can subscribe and get that at passiveinvestingstarterkit.com. And then from there, happy to answer any questions you have.
Love it. Well, thanks for the generous offer. We'll make sure that's listed below to get people kickstarted in the right direction. We'll list the book, everything else, so people can go out and access it. And with that, Pascal, thanks for coming on the show, and I hope you have a great rest of the day.
Thanks, Kent.